Now let's look at the procedure of creating an optimal portfolio. Let's say I want to invest in a set of securities S1, S2, S3 so that I'm diversifying. I am trying to reduce my risk, right? Now the question comes, what should be the investments in each one of them? What is that optimal portfolio? Let's say I am interested in earning a return of 10%. What should be the optimal portfolio for me? Right? How much should I invest in S1? How much in S2? How much in S3? In such a way that the overall risk that I am taking is the minimum most possible. So this is the whole dilemma that runs in any kind of investment situation. It could be an investment in stocks, it could be an investment in bonds, mutual funds, almost any currencies, commodities, gold, wherever you want to invest. The problem is the same. What proportion do I need to invest in what? In what way I can decide on that? So that is what we'll try to explore now. Let's say I'm looking at the different indices which are there on the Bombay Stock Exchange. The banking index, for the last 1 year, I'm looking at how these values have changed. The banking, the healthcare, the auto, the consumer durables, capital goods, fast moving consumer goods, IPOs, IT, PSUs, public sector, metal, oil and gas, power, realty sector, and technology stocks. Now, here, my intention is, right? Okay, I want to invest in these sectors. I'm not too much specific about a specific stock or something. I want to invest in these sectors, and let's say I want an annual expected return of a 12%. For convenience case, I'll take the historical returns that I'm getting, the historical returns. I'll make an assumption that those returns are going to repeat in the future. So I'll take them as the expected returns for the future as well. Whatever are the historical returns, I'll take them as the expected returns for the future. So now let's see what is that, in which sector I should invest how much to get what. Alright, so let me go ahead with taking the headings as it is. Right, I'll simply copy the headings up to here, and that will let me take it. Okay, wherever it's not applicable, I'll take that out. Alright, up to here, only the data is present. And this column also being the date, I'll change this to the date format. Rather than being in the general format, I'll change this to the date format, right, where I'm getting the numbers as it is, and probably the other headings, the values. Okay, here I really don't require the values. Probably I'll compute the returns, right? There is no need in replicating the values again. What I'll do is, in this section, in this sheet, I'll compute the returns, but here I'll take the logarithm of the returns, logarithm of the ratio of the prices, rather than the prices as such, rather than the standard return. I'll take the logarithm return. So I'll call this as this number divided by this number. This is the logarithmic return. So the same thing, I'll copy it across and probably I'll drag it down. And for ease of look and feel, I'll convert all of them into percentage form. So this is the return, daily return, which I have measured using the logarithmic scale. This is the daily return for each of the stocks, right? Now I want to invest some amounts in each one of them. So probably let me call whatever I wanted to invest in these 14 sectors, I'll call it as W1, W2, so on, W14. So I am taking this as one vector. Whatever are the weights that I want to invest in each one of them. Similarly, I'll take the returns, right? I'll take the returns of each one of them, which I would like to invest. So let me call those returns as the expected returns, or probably whatever is the average return in each of the cases. I'm calling that as the expected. So here for comfort level, here what I'll do is I'll simply compute the average. I'll simply compute the average return for all of them. So this is the average return across all the sectors. So what I'll do is I'll expect the same to be the return even for the future. So I'll take a vector called expected returns for each of the stocks. So for each of these 14, I'll directly use the transpose function. Using the transpose function of Excel, I'll simply transpose these values here. Right, so probably again I can maintain the percentage forms. So which means these are the expected returns of all these 14 sectors. Now, as I said, I'll also maintain a weights. Probably like for the simplicity purpose, let me call the weights as, okay, because there are 14 sectors, let me call 7% in each of them, and probably the last one being the 9. Overall the summation is coming out to 100%. So I'll do the summation of the weights, and I'll simply say that the summation of all the weights in all the sectors is coming out to 100%. Now let's say these are the weights in which I wanted to invest in each of these sectors. Now if I really am thinking like this, I can very well find out the expected return. Alright, the expected return, if I am investing in this proportion, the expected return of the portfolio, I can take it as using a sum product. I'll say the multiplication of this with this pairwise multiplication is what is being done by the sum product. So the expected return is going to be something around this. And of course, this expected return is actually a daily return. So probably if I'm really interested in annual return, I can even try multiplying it by the total number of observations that we have in our data. The total number of observations that we have taken for computing the average. Okay, so it is working out. If I am investing it in this proportion, it looks as if I'm getting 28.64% return. Great, right? If I'm going in this proportion, my expected return is almost 28.64% on an annual basis. Now comes the next aspect, wherein I'm also looking out. Right here, let me call this sheet as the return sheet. So the expected return of this particular portfolio is coming out to be around 28.64. Now I have to look at the risk side as well. I have to compute the variance of this portfolio in case I have invested in this proportion. Right? In case I have invested in this particular proportion, this is what is the expected return that I am getting. But I am also looking at what is the risk. And to compute the risk, I require a variance covariance portfolio or variance covariance matrix. Variance covariance matrix. What is the way out to get the variance covariance matrix? I'll simply use the formula covariance. Right, I can simply use the formula covariance between, I'll use the covariance between, let's say this particular column of data. I'll do the covariance between this particular column of data, comma, the same column of data. Okay, let's see how it works. Let me take the covariance between this and this. Now if I do this, yes, this is nothing but the variance, fine. But the problem is, if I drag it, I want to drag it across so that I get the variance and covariance for all of them in one single go using an Excel formula. So what I should typically be getting is, as long as, see here, I should get the covariance between banking and banking. If I come here, it should be covariance between the banking and healthcare. It should be the covariance between the banking and the auto. But if I write the formula like this, I will not be able to generate the covariance in that particular manner. Right? If you simply look at this will, okay, if I freeze this here, but let's say I'm not freezing it here. Right? I freeze it here, I'm not freezing it here, which means, okay, here I'll get it as a variance, but when I drag it across, I'm getting the covariances between, just to check this out, let's say if I'm taking the covariance between the banking returns and if I'm taking it between the banking returns and the healthcare returns, yes, I'm getting it exactly the same. So at least as a part of this variance covariance matrix, so these are the covariances that are existing across. Right, just for the naming part, I can still give the names which are exactly the same. You can think of quite a few other formulas which can come in more and more handy. Right, quite a few other formulas which can come in handy. But in some cases, I can even think of a much more appropriate mechanism also. But yes, to simplify the stuff, the same formula I can very much copy. If I have to do it in a simpler manner, I can copy the same formula here. The only difference being, now I'll change the alphabets of the first. That's it. If I change the alphabets of the first, now I'm changing this to B, C. Then again, I can change this to D. So this is how I can very well improve or quickly generate a variance covariance matrix for myself, right, with respect to E. Otherwise, you can think through a formula using index, offset and index, which can generate the similar kind of an effect for you. Right now, I'm not getting into that specifics of using the index and offset formula to generate this variance covariance matrix, because here it's just the conceptual part that you need to be comfortable with. So if I am generating the variance covariance matrix for this entire chain, right, probably here also I can use the transpose function and I can get these headings comfortably, right, and the same all these formulas when I'm copying them across. All right, so here I'll change it to H. This will get changed to I. Between a few sectors looks like there are negatives, right? Between a few sectors the covariance is looking more and more negative, especially between IT stocks and the banking stocks there is a negative covariance. L here. Here I substitute this with L on both the sides. Then I can go with M. The same logic probably becomes much simpler if you are using your index and offset, right? But yeah, here I'm doing it manually through this. All right. Now once I have this in place, I can drag these things across, and now I can very well say that this is my variance covariance matrix. This entire, because I am looking at the pairwise variance and covariance across all the different possible values. Now comes the next part. Now that I have got into the variance covariance matrix, how do I find out the portfolio variance here? This is where again I get into, right? If I have to compute the portfolio variance, all I am looking at is whatever the weightage that we have. The simple way I get into the portfolio variance matrix is I take the weightage transpose, I take the transpose of the weights, multiply it with the variance covariance matrix, and again I multiply it with the weights. The three matrix multiplication, these are three matrices. The multiplication of these three matrices is giving me the variance of the portfolio. So here I'll talk about the matrix multiplication of. So we have to do step by step. Okay, first of all, let me do the transpose of the weights. Right, let me do the transpose of the weights to start with. Let me do the transpose of the weights. Alright, let's use the transpose formula to do the transpose of the weights of all these. Okay, so these are the transpose of the weights. Then all we are saying is I want to do a matrix multiplication of WT times V. So W transpose multiplied by V. First of all, let's understand W is actually a 14 by 1 matrix. Then V is a 14 by 14 matrix. And W is 14 by 1. W transpose is 1 by 14. So it's as good as saying 1 by 14 matrix gets multiplied with a 14 by 14 matrix, which again gets multiplied by 1 matrix to finally give us a 1 by 1 matrix, which is nothing but the variance. So let's do it in two steps. So first I'll take the W transpose multiplied by the variance. Okay, so matrix multiplication, the first array being the W transpose, the set, and the second one being the matrix multiplication, which is the variance covariance matrix, right? So this is the W transpose, which actually should give us the 1 by 14 matrix. So if it has to give me the 1 by 14, I can very well take this area, then do a control shift enter. So this becomes my W transpose times V. This entire number, this entire matrix, I again do a matrix multiplication to arrive at the variance of the portfolio, which will give me the matrix multiplication of this set. I say I want to multiply this with this set. Again, being a matrix multiplication and results in a 1 by 1 matrix, I get the variance of the portfolio. This is a 1 by 14 matrix, and that's a 14 by 1 matrix. Let me check how many are there. Only 13 are there. Probably I have to do it for one more row. The same logic. Okay, so these are the 14. So from here, we'll say that the variance of the portfolio again is the matrix multiplication from here to here, and I have to multiply the same with the weights which are from here to here. So let's see now if the variance of the portfolio is coming out. Yes, now the variance of the portfolio has come out. And probably if required, if I want to take this as the annual variance, I'll again multiply the same with the count of whatever the returns data, that number of days of return that we have considered. I'll multiply it directly with the count of that, which will give me the variance of the portfolio, right? So I'll take the count from here to here, which will give me the variance of the overall portfolio, annual variance of the portfolio, and probably annual standard deviation of the portfolio. If I want, I'm taking the square root of the annual variance of the portfolio. So this number comes out to be the annual standard deviation of the portfolio in case I am investing in this proportion in the various sectors of the economy. Now comes the next question. Yes, I want to generate, let's say, a 30% return, or probably let's call it as I want to generate a 20% return, which will have the least possible risk. right? I want to generate a 20% return with the least possible risk. Now this is where I'll use the tool of Excel like solver to solve this problem. Right now I want to have the minimum most variance or minimum most standard deviation, but it should give me an expected return of 20%. Right? So for that I am setting up the solution in solver, setting up the problem in solver, wherein my objective is to minimize the standard deviation. So I'll select the annual standard deviation and I say minimize, but I want to change the values of these cells. Actually this is entirely happening through the Lagrangian functions, but of course because we are using the tool, there is an optimization tool called solver, so which can generate this output for us quite comfortably without setting up the matrix equations and all that stuff. So I'm changing these variables. Now what are my constraints that are there? All right, so here initially let me start off that the summation should be equal to 1. That's it. I don't want to put any kind of constraints, let's say on the weights, but sometimes I may say that those weights have to be positive only. See, if I am putting a constraint that the weights need to be only positive, which means I am only investing in them, there is no shorting process. There are restrictions with respect to shorting. But if I am allowing them to have even negative values, then I am even relaxing the criteria. Okay, let me first put the summation should come out to 100%. Okay, let me put the criteria for you. Let me say that all these individually, they should be less than or equal to 100%, and individually they should be greater than or equal to 0. Let's say I'm putting a condition that they can't be negative and they can't be more than 1. Means only by positions are possible. Right? And at the same time, I'm also setting that the expected return for me should be equal to 20%. I want a 20% expected return. Okay, so these are so many constraints that I have set, wherein my objective is to come out with the best pattern of all these proportions so that I can make my investment decision accordingly. Now if I am asking my solver to solve the question for me, all I am getting it is, yes, some sectors it is asking me to invest, in some sectors it's not asking me to invest. Overall it is generating 20, which means it is saying probably in one of the sectors, the second sector. Okay, now let me see what are each of these sectors. First of all, I'll get the names so that I can correlate much better. Right, I'll get the names much better. So I'm getting the transpose of the names from here. I'm getting the transpose of the names from here, wherein I am getting that the logic that I'm getting is almost invest 17.67% in the healthcare, around close to 1% in the capital goods. So there is a kind of a decision that I am getting. 35% go with the FMCG, 4% in metal, 14% in oil and gas, and probably around 25% in the technology stocks. That can generate you an expected return of 20%, which is minimizing your variance on the other side. Your standard deviation is only to the extent of 0.098, or with 9.8% standard deviation you are able to generate a return of 20. But let's say now my objective changed. Some other customer came in. He wants 30% return. He is not looking at 20% return. he wants a 30% return. So which means this objective has to be changed from 20, I'm making it 30%, right? Rest all remaining the same. Now it says, yes, if you are really targeting for a 30% return, this is the best combination. Look at the healthcare, increase your investment in IPO, in FMCG, which are generating the least possible return for a 30%, least possible risk for a 30% return. Your annual risk is only to the extent of 9.66. Now, these are only the situations where all these values are positive, which means only the buy positions are there, means buy and hold positions are there. But what could very well come out is, apart from buy and hold, I can even think of shorting wherever possible. So whenever I'm thinking of shorting, I don't have any kind of constraints with respect to they being positives, they being only less than 100%. I don't have any such constraint, because I am making an assumption that I can short to any extent. So if that's the case, what is the situation that is getting created for me? These two constraints, I'll directly remove them. Right, these two constraints, if I remove, saying only the summation should be 100 and the 30% should be the return for the portfolio, which means the more flexibility is coming out to my weights, which is clearly telling me now if I ask the solver to solve it, yes, it has given a better solution with a few negatives. It says, yes, short the IT, short the power, short the reality stocks, go ahead and or short the consumer durables, invest in healthcare. 23% you invest in healthcare, 31% you go into consumer durables, or sorry, FMCG, 33% in tech. Overall, you can generate 30% expected return, but which will have an annual standard deviation of just 9.34%. So depending on the objective of the client, depending on the returns which is expected for the client, we can very well alter the portfolio. We can generate the optimal portfolio which can generate the minimum possible risk for the targeted level of return. So that is what is the objective behind generation of an optimal portfolio. Along with the conceptual aspect, we are building in the Excel based workout in terms of arriving at the standard deviation as well as the variance computation using the variance covariance matrix, etc. Now, another simpler way to look at this whole story, rather than building this entire part is I create one column called portfolio. Right? I create one column called portfolio wherein I am simply looking at the weights multiplied by the returns. Right? So I am talking about the weights multiplied by the returns pairwise. So I could very well do the first one with the first and so on. So this is a 14 by 1 matrix and this is a 1 by 14. So I could very well do a matrix multiplication of 1 by 14. Right, I could do a matrix multiplication of 1 by 14 with these weights, a 14 by 1 which I can freeze. So this will give me, this is the portfolio's returns. Right, if these are the weights, these are the portfolio returns. Now what I can simply do is, here I'll try computing the expected return of the portfolio, which will give me the average through this mechanism. This is the expected return of the portfolio. This is a daily return, so I'll multiply it with the count, right? I'll have to multiply it with the count of something, which will tell me that the expected return of the portfolio is almost 30%, which is what is my objective. Then I could also find out the standard deviation of the returns. So the standard deviation of the returns of the portfolio is also, if I'm looking at this, the standard deviation, this is the daily standard deviation. This I can multiply it with the square root of the time period, square root of the number of days, because variance will multiply it with the count. So the standard deviation I can multiply it with the square root of the count to overall arrive at this being the standard deviation or square root of, I have to do the counting of these, right? I'll have to do the square root of the counting of these numbers, which is giving me almost the same 9.34%. So I could have done this portfolio. Now let's say for a 20% case, I could either minimize this or I could minimize this. Both of them will lead me to the same solution. Now let's see if I want to do any of these. Probably I could go here. Let's say my objective is I want a return of 40%, not 30. I want a return of 40%. Let's see if it is possible. I want a return of 40%. What it says, yes, if you want a return of 40, it is possible. Your portfolio standard deviation will go to 9.67%. But the way you have to work out is you have to invest very heavily in the IPO, you have to invest very heavily in the FMCG, in the healthcare, in these sectors you invest. You short from power reality kind of sectors, and this is what can generate an expected return of 40% for you. Now I could have done it through that variance covariance approach and the matrix computation and all, or we could have simply taken a portfolio like this, multiplying the weights with the individual returns, compute the expected return of the portfolio, the standard deviation of the returns of the portfolio, minimize the standard deviations and equate it to the expected returns. So the expected returns are coming out to 40%. The standard deviation is around 9.67%. So this is how we can, these are the two methods that are available. Theoretically, it is first finding out the variance, covariance matrix, right? And finally getting into finding out the optimal combination of the weights. But on the other side, it is as good as take some weights, dummy weights. Based on the weights, you compute the portfolio's value, daily portfolio's value, portfolio returns, and take the expected returns, take the standard deviation of the returns, minimize the standard deviation of the returns by setting the expected return to the desired level. And that's how I can build optimal portfolios with any kind of combination of investments in different securities. All right.